Hello, everyone, and thank you for joining us today for what I believe will be an informative and exciting discussion on finding alpha in private markets. Though we wish we were all in Austin, it's great to be able to be here for this virtual discussion. I'm Monica Villarreal, lead counsel at Rock Creek, and I'm joined today by two of my colleagues, Siddharth Sudhir, who is managing director, and Matt Bullough, a director at Rock Creek, both of whom lead Rock Creek's efforts in investing in private markets. Matt, would you like to begin the discussion by giving a bit of background on Rock Creek's history of investing in private markets?
Of course, happy to, Monica. But let me start by just saying thank you to TRS for its creativity and finding a way to still host this event. It's always extraordinary, even in a virtual setting. I also hope that everyone's staying safe and healthy in these very interesting times. But back to Rock Creek's history of investing in private markets. I think if there's one thing that Rock Creek's founder and senior partners have excelled at, it's evolving our business based on what we perceive to be the market opportunity or what we perceive to be investor demand, and always really staying one step ahead of the curve, right? I think this was true in how we built our technology platform, how we've built out our team, and especially true with our investment focus, right? So as a firm, Rock Creek has been investing in private markets since 2015. So since then, over the ensuing 5 to 6 years, private market investments have really grown in importance to the firm as we've continued to take on capital either through dedicated private market focused portfolios or within other portfolios that take more of a multi-asset approach. I think when you look at the business today, Rock Creek truly is a global multi-asset investment firm, with the majority of our 16 or so billion in total assets managed through these multi-asset portfolios. Today, we have substantial exposure across private credit, across real estate, across private equity, and there we have exposure across venture growth and buyout. And one thing I'd say that's especially important to this audience, even when investing in private markets, we still recognize the value of emerging managers. So establishing these relationships with next generation talent, and these investments, these relationships make up a material portion of our exposure across private markets.
And Siddharth, did you want to touch on just sort of Rock Creek's experience investing in private markets even prior to inception of Rock Creek?
Yeah, absolutely. And first of all, thank you, Monica, for having us today. And, we obviously wish we could be in person with all of you in the convention center, like in prior years, but hope that's the case in 2022 and beyond, and hope everyone's staying healthy. But, just adding on to what Matt had discussed, I think Rock Creek's background in private markets goes back even prior to the firm's inception. The founder, Afsani Beshlos, and the team that came from the World Bank were pioneers introducing private equity, real estate into the World Bank's venture capital, into the World Bank's pension plan. So we were very early investors in some of the early private equity firms at the time. And so we always had that background. When the firm started, we may not have per se managed actual client capital in that. But many of those relationships with top tier GPs continue to this day. And as we began investing more in the last 5 to 7 years in this area, it was very easy for us to kind of access some of the best GPs in the space. So this is something that I would reiterate is not new to Rock Creek. I think many of our senior members have been investing in private markets for a number of years. In fact, Afsani actually was the 12th partner at Carlyle before Rock Creek became a firm. So this is something that's very much in the firm's DNA.
Excellent. Thank you, Siddharth. Now, turning to due diligence, could you please expound on the due diligence process for private investments?
I think first and foremost, obviously, there are variations between the different types of strategies. But I think, if you look at a common thread among all managers, be it public or private, is obviously the background of the team, where they have been, what kind of track record they have previously. We look at both emerging and established managers. I think that's important. I think one of the things that's been important for the firm since the beginning is identifying talent early. And so be it in public markets or private markets, we don't mind being a fund one investor in certain cases, or even being an anchor investor uh, if the situation warrants. Um, but in terms of things that we look for, it would be no different than probably what uh, most people focus on, right? So it's essentially the organization, the track record, culture of working together, what is the current market opportunity in which they're executing the strategy, and having an institutional infrastructure in place that can manage institutional capital. I think uh, many of our questions will follow into one of those areas. We have a very strong team with knowledge, not just on the investment side, but obviously, Monica, yourself included, on the operation and legal side as well, that really will go into documentation review, ensuring that what they see is common market practice and so on. And so we're indifferent between established managers. We are looking for funds that can deliver top decile returns for their vintage on a going forward basis.
Matt, what are some of the requirements that Rock Creek places on private market GPs?
I would very much echo and reiterate everything Siddharth just outlined. Importantly, Rock Creek's investment process follows the same steps regardless of the asset class, or a manager's status is either quote unquote emerging or established. Every manager that we underwrite receives an independent assessment, not only from our investment team, but also from our operations team, our risk team, and our legal team. And each one of these groups has the ability to independently veto an investment. I think when it comes to private markets, careful due diligence is especially paramount. Primarily, and this for the simple fact that once you invest or commit, you really have no ability to redeem. Right? This is a structural a structural fact with private market investments. Once you have committed to a fund, you have legally agreed to partner with that GP for the term of the fund. And for this reason and this reason alone, I think it's really important to get that decision right. Also, unlike hedge funds or other traditional investment types, most private market investments involve committing capital into a blind pool, right? You don't know what you're buying. You're not able to buy a fully baked portfolio. And again, for this reason, we found and come to expect that our private market GPs provide a tremendous amount of transparency. And that's not only on the business, but on the portfolio and specific deals that they're pursuing, right? Both past, present, and future. I think we want to use this information, this transparency, to understand the market opportunity, the strategy, and to the best extent possible, what the portfolio should look like when it is fully invested.
Would it differ between asset class if you're looking at a real estate fund versus private equity, or do you take the same approach?
I would answer this question by saying both yes and no, but let me extrapolate because that's a vague answer to your question. And I'll start with the easier side of it, the no. Again, just to reiterate that Rock Creek's investment process is equally rigorous across asset classes, right? We're completing the same due diligence process, the same teams are involved. So that part of the question is relatively easy to answer. As for the yes side of my answer, right, there are nuances when it comes to completing diligence for certain asset classes, but I think this is easier explained through some examples. So I'm going to stick to my area of coverage here, private credit. And as a very simple example, we recognize that some of the underlying investment structures used by the funds that we invest are, they're complex, right? So for this reason, we might spend more time on how a manager goes about structuring its investments. More time spent here than might be necessary with other private market investments, such as private equity, which don't need to consider such things as covenants, term, structure. Is it a revolver? Is it a term loan, etc.? What are the fees and other penalties and other elements that might come into effect that may impact either IRR and multiple of an investment, right? So that's one aspect. As another example, and I guess taking a step back and just thinking about private credit in general, private credit is an asset class that was born out of the GFC, right? Due to the retrenchment of banks and other traditional forms of finance. For this reason, many private credit strategies are looking to fill unmet liquidity needs in the market, right? Requires significant market research done by us in order to understand that market opportunity. What are the supply-demand dynamics, and what is the competitive landscape? So we really want to understand if we're allocating capital to a market opportunity, is that market opportunity going to persist for at least the term of the fund?
And just, as we've seen, of course, over the past couple of years, institutional investors increase their allocation to private markets as they are looking to hit return targets. What roles do each private market asset class serve in an institutional portfolio?
The truth is that the traditional 60-40 allocation framework is really no longer sufficient in generating the investment returns required by institutions to achieve their investment objectives. Pension plans, they need to generate return for the teachers, the policemen, the firefighters, and the other retirees that they serve. University endowments, they need to be able to support their students, their teachers, and the communities. Other nonprofits, they might need enough capital to write grants and pursue their mission-driven philanthropic endeavors, right? So everyone has their own unique investment objective. I would say broadly, each private market asset class helps provide diversification benefits and higher total return potential. And this is done through capitalizing on both illiquidity and complexity premium that's not available in public markets. Right? I think above and beyond that, all private market asset classes offer an investment return that is, or should be at least, less correlated to the prevailing market cycle. And this will therefore allow investors to avoid any unnecessary drawdowns in their portfolios. Again, sticking to my realm of coverage, credit, it's interesting if you look at some of the facts, right? That no one's going to argue the fact that public market fixed income securities are trading at all-time low yields and offer investors, said plainly, what looks to be pretty unattractive, a pretty unattractive convexity profile, right? So no one really wants to go out today and just buy credit beta. That doesn't seem like a winning strategy. Compare that to private credit, right? Private credit offers investors superior return potential, superior risk-adjusted return potential. So not just total return, also risk-adjusted return, less mark-to-market volatility, and it's also going to provide investors with some degree of intermediate liquidity, whether it's through quarterly distributions of income, or the return of principal at maturity. So there's value to that liquidity, I think, to all investor types.
Thank you, Matt. And Siddharth?
Yeah, no, thanks, Monica. I think Matt addressed the credit side well. And, I would only add that, we're seeing a real bifurcation within the private credit universe. I think there are strategies and funds being raised which are more income oriented, and those which are more capital appreciation oriented. And I think the way institutional investors are looking at that really varies. Given where interest rates are today, I think, people are really looking for yield and looking for income. And so there's a lot of drive for income oriented strategies within the private credit universe. And I think allocators are looking like that to put that within their fixed income allocation. Because given where high yield spreads that are at an all-time low, given where treasury yields are, the asymmetry between duration and yield, it's really the question that a lot of people are asking. How do you replace the traditional 60-40 allocation? And so income-oriented strategies within private credit is definitely something that is getting a lot of attention. Capital appreciation like distressed is, I think that has been an investment strategy that's always been in play. I think their managers really have to distinguish themselves from some of the large established managers who have been doing this for many years. And so that would be something that I would advise emerging managers who are thinking of launching such strategies. Moving to the other two asset classes. So real estate, I think we are really at at an interesting inflection point. Obviously, I think the pandemic has impacted that sector more than any other sector within the private market asset classes. Commercial real estate, obviously, um, certain properties like office and retail have seen significant dislocation. And so the question is, what is the future of commercial real estate and in certain properties, given certain secular changes like work from home, among others. And so, really, I think investors are looking at the space as an opportunity going forward, but
Mhm.
really like taking a surgical approach. I would say that for us, we are very much thematic driven in those areas. There are a few key themes that we really like going forward, and have really been looking to uncover managers that are able to take advantage of those themes. And those include, we really think affordable housing, especially, will be a priority given the Biden administration is coming in. We think that logistics and industrial will continue to benefit as people have kind of adopted more online purchasing, and consumer behaviors change in that regard. We also think that certain multifamily properties will continue to recover. People still need a place to stay, and obviously, we do focus on niche opportunities such as triple net lease strategies as people have looked for liquidity. So we take a rather opportunistic approach, but these are some of the themes that we have been looking to deploy capital in. I think how do investors look at real estate? I think they're really looking at it as a way of protecting capital as inflation rises, right? So that's the traditional way that real estate and real assets more generally have been used in an institutional portfolio, and I think that will continue to be the case. And so I think, given that with the Biden administration, spending is expected to increase, and so one would think that inflation, maybe not immediately, but over time may go up. And so in preparation for that, we have seen many institutional investors look to increase their allocation to real assets, but really picking their spots in terms of where they want to deploy that capital. Maybe turning to private equity, again, there's no asset class that has seen significant demand that private equity. Uh, there's not a day that goes by when you don't see an investor increasing their target to private equity. And I think with opportunity comes risk. And I think, we spend a lot of time really understanding the backgrounds of the people who are running the private equity firm. How do they plan to generate similar returns going forward? I think that's a big question mark there, right? I think,
Yes.
a lot of folks have benefited from the strong run in public equity markets, which have obviously been a huge tailwind for private equity, specifically in sectors like technology, which have done exceedingly well. And we too have been beneficiaries of that within our investments. The question is, going forward, where do those opportunities lie? I think where we really seek differentiation is the ability to add value through an operational angle. I think um, uh, the ability to add returns through leverage and multiple expansion are things which are not really more beta oriented ways of adding returns. I think the managers or GPs who are really unique have that ability to have operational expertise in the businesses they're buying, and looking to build it that way. So I would say that is something that we are looking for on the private equity space. We are looking both at the US as well as globally. We are, as we have talked about, we are a global investor. So all of the opportunities that we are looking for so far, not just in the US, but globally as well. We've been active investors, emerging markets. We have a large emerging markets business, and that allows us to find many opportunities in private market opportunities in emerging markets where it's still very nascent relative to how much capital has been deployed in both the US and Europe. So we've been very active in China and areas like that, where we think that continued growth would be beneficiary.
Thank you. Now, turning to capital raising. As emerging managers are raising capital in today's environment, is there any advice you would give them to differentiate themselves from other managers?
I think the most important thing is showing how you're differentiated, right? Just as there is a lot of private equity money that's looking for a home, there are a lot of private equity funds that are being raised, and a lot of first-time funds. So, with opportunity, obviously, a lot of people want to tap that opportunity to get permanent capital. So the question that we would say is, why you versus the crowd, right?
Yeah.
And there are multiple ways that you can answer that. Is it your prior track record? Were you at a large firm previously, and you wanted to be an entrepreneur and start your own firm? Are you able to show some kind of deal level track record? Is the opportunity set that you're currently executing, is that rather unique? What's different about it versus maybe a more established firm where an institutional investor can get more comfortable? What about the team? Many of our experience has shown one of the single most reasons why firms, early stage firms fail is because there are cultural issues with team members. So has the team been working together? How have you put your team together? Has there been a shared working experience in the past? Third, what kind of operational infrastructure have you put in place that will make institutional investors comfortable? Do you have proper CFOs, CEOs, and all of those kinds of people in place that ensures that no issues are arising? I mean, unlike a public market investment, again, you're requesting an investor to commit for multiple years, and so a lot of comfort has to be given to us to make that commitment. And so those would be a few of the factors that I think are important. And so that's what we would recommend as you guys think about, launching your first fund.
Excellent. Thank you, Siddharth. And Matt, I know you have a lot of conversations every day with managers. What sticks out in your mind and really differentiates a manager?
Yeah, thanks, Monica. Yeah, no, it's true. I spend a lot of my time speaking with emerging managers and would start by acknowledging that the fundraising environment is as challenging as it's ever been. The truth is there's just a lot more demand out there than supply when it comes to capital. And I think the fact that there's nearly 2,000 GPs in attendance today in this conference is really a testament to that, that supply-demand balance. That said, the process that Siddharth and I described earlier, those attributes that we're looking for when allocating to emerging managers are really what governs where capital will flow. And at the end of the day, we're looking to back new and emerging firms and teams, but at the same time doing our best ability or doing our best to limit our exposure to new business risk. I would say my advice to emerging managers and taking that into consideration is to build the business, build the infrastructure, build the team that you need to successfully execute your strategy, and do so before raising external capital for the fund. I think as an allocator, we look at that and we see significant alignment of interest through that investment into the business, and I've grown to really believe that that's a prerequisite to us investing alongside a GP. We as allocators are also looking for differentiation. So I think, as that relates to investment strategy, you're better off if you're pursuing an investment strategy that is uncorrelated, that's not yet commoditized. We're seeing so many opportunities come our way. We are going to be way more interested if you show us something interested and new, right? And finally, I guess my advice to emerging managers would just be patient, right? I think Rock Creek looks to be long-term oriented in our relationships. We hope that the GPs that we do end up partnering with understand that these relationships, the best relationships, take time to establish, right? The better that we understand a strategy, the more patient we will be if and when something goes wrong, right? We don't want to be investors for just one fund. We ultimately want to participate in as many successful vintages across as many cycles as possible, right? So this type of relationship takes time to build.
Now, let's switch gears to our positioning. How was Rock Creek positioned going into 2020, and how did the pandemic cause us to reevaluate our positioning to take advantage of opportunities?
This pandemic has been interesting in that so much has changed, right? In how we work, how we socialize, you name it. Yet, if you looked at the market in early 2020 and again in early 2021, you really wouldn't appreciate the extreme market volatility that took place at various points in 2020, and specifically towards the end of Q1 and beginning of Q2. At Rock Creek, well, we spent a considerable amount of time looking at market opportunities specific to those market dislocations that occurred last year. The speed at which the market recovered ultimately limited any wholesale changes we were able or would want to make to our broader positioning. In private credit, we are sticking to our knitting. So doing the same thing we did before the pandemic that we plan to do after. And that's a few things. We're going to focus on strategies that generate a significant portion of return from income, whether that's through current coupon or other forms of income. To Siddharth's point earlier, we're going to stay senior in the capital structure. We're going to invest in jurisdictions with favorable credit rights. We're not going to be dependent on capital markets for an exit. And we're going to invest at favorable attachment points where there is significant collateral backing, and ideally that's going to be hard collateral, right? None of this has changed pre and post pandemic. That being said, I do think we recognize that the pandemic has accelerated certain secular trends and made specific sectors and opportunities more attractive, and given us a reason to really focus on these specific opportunities. So I would say, like with real estate, as Siddharth discussed previously, we found certain themes to be particularly attractive within private credit in the current market environment. And, just to give you a sense, these include asset-based lending, right? This does also include opportunities in the more niche stretch ABL market, given that there are pockets of corporate stress and distress out there. We're finding interesting opportunities around niche lending, specifically to meet unmet liquidity. So to give you an example there, opportunities using both LP and GP interest in funds as collateral for more lending-based transactions. And then also, I think generally we find special situations, albeit a broad term to describe a wide range of strategies, but special situation strategies to be interesting, and particularly those that are focused on less competitive geographies such as Europe and Asia. So strategies that are finding idiosyncratic opportunities, sometimes even in more COVID impacted sectors. So not a wholesale change in positioning, but definitely finding some very interesting opportunities to pursue.
Excellent. No, that's a really interesting opportunity. Thank you for sharing that, Matt. And Siddharth, just looking ahead, where do you see the opportunities? Where are you bullish and where are you bear?
Yeah, no, it's the $1 million question, right? No, but on a serious note, I think Matt talked a lot about what we've been doing on the real estate and the credit side. Maybe if I talked a little bit on the private equity side and the venture side. I mean, those are areas that we've been very active with, and those are been with GPs that have held up reasonably well through the course of 2020, and we think are well positioned to continue to outperform in 2021. I think as markets begin to normalize even further, I think 2021 should be a reasonably strong year for the private equity asset class. In fact, history would show that funds which are raised during the market sales tend to be one of the strongest performance going forward. So we were active. I think despite being virtual, we were able to make commitments to new GPs and new managers over the course of the year, which I think speaks to how technology has changed all of us today. In terms of opportunities, I would really say we continue to look for secularly growth opportunities, and I think there's a continued focus on picking your spots here in the US So technology has been obviously an active area which has worked out, but really like trying to identify areas within technology that could see future growth going forward, and um, as opposed to being in the traditional crowded sectors like software or SaaS, but seeing if you can, go one step further and see where the real innovation is, be it in cybersecurity or in other areas like that within the technology sector. Healthcare, we think, obviously the pandemic has shined a light in terms of how much healthcare is needed in terms of innovation. And so really like investing in like funds that are looking at growth opportunities in early stage to late stage healthcare companies would be the two areas that I think we are particularly find compelling. And as I mentioned, in your last question, Monica, I think for us, the opportunities are not just in the US, but also in
Yep.
globally. And I think we've been spending a lot of time in Asia and emerging markets identifying whether those secular trends will continue there. And so I would say we're taking that approach, not doing anything too radical. We've invested in very strong GPs, both early stage as well as mature ones, that have performed well through the recent pandemic, and have continued to invest successfully, and are back in market. So our focus really has been recommitting with established managers, looking for new talent, and identifying, continuing to invest in areas where we see secular tailwinds in terms of future growth.
Thank you, Siddharth and Matt, for your insights. It's certainly an exciting time to be investing in private markets, and we hope you enjoyed our discussion today.